On July 4th, 2025, cameras flash, a signature is signed. It locks in one of the largest permanent changes to U.S. corporate taxation in decades. Markets rise. Headlines celebrate a new era of growth. But behind the rally, something unusual is happening. While the public reacts to the headlines, corporate insiders are selling. Chief executives, board members, major shareholders. They are not buying the optimism. They are liquidating their personal holdings at the highest rate in 20 years. That divergence matters. When the people closest to the numbers sell into positive news, it usually means the public story is incomplete. The public explanation for this legislation is straightforward. Stimulate investment, create jobs, support the middle class. That explanation depends on one assumption: that the system itself is healthy. The data suggests otherwise. This is not a left versus right issue. Across history, every modern government, regardless of ideology, eventually collides with the same constraint: mathematics. We are entering the final phase of what economists call the sovereign debt cycle. A sovereign debt cycle ends the same way every time: when the cost of servicing debt grows faster than the economy that must repay it. At that point, economic growth no longer solves the problem. Borrowing only postpones it. In late-stage debt cycles, governments begin to lose voluntary buyers for their debt. When that happens, they turn to the largest remaining pool of capital: pension funds. Quietly, and often without public discussion, retirement savings become forced buyers, not to earn returns, but to keep the system functioning. That is how pension funds become exit liquidity for a crisis already locked in by arithmetic. According to current data, that point arrives by early 2026. To understand why the timeline is fixed, look at the ledger. As of September 2025, United States national debt stands at $37.4 trillion. The number itself is not the key issue. The cost of carrying it is. In fiscal year 2025, net interest payments approached $1 trillion. For the first time in U.S. history, interest payments exceeded the entire defense budget. This creates a constraint of insolvency. To pay interest, the Treasury must borrow more. In the first 2 months of fiscal year 2026, the government borrowed $439 billion. That is roughly $7 billion per day. This spending does not stimulate growth. It only prevents default. This is the backdrop for the legislation now being praised. Public Law 119-21, the One Big Beautiful Bill Act. It does not reduce debt pressure. It increases it. By lowering top tax rates to 37%, the bill expands the gap between revenue and spending. Over the next decade, that gap grows by an estimated $2.77 trillion. Supporters argue tariffs will compensate. That argument assumes a static global system, one where trade partners do not respond. Supply chains remain fixed, demand remains unchanged. History shows this assumption does not hold. Think of a business selling its equipment to cover operating costs. It creates cash today, but removes future capacity. That is the position the U.S. economy is in. Short-term relief, long-term damage. This brings us to the question of timing. Why 2026? We do not need to guess. We can observe where independent indicators converge. One such indicator is the economic confidence model developed by Martin Armstrong. The model does not measure sentiment. It tracks capital movement. According to the model, the global economy is in a private wave, a period where confidence exits public institutions and government debt and moves into private assets. The model identifies a convergence point at 2026.075, late January 2026. This date does not cause the crisis. It marks the moment confidence breaks. This aligns with historical patterns. Large financial crises develop in stages. In 1929, leverage concentrated in margin loans. In 2008, it concentrated in subprime mortgages. Today, the leverage resides in sovereign debt. Equity markets remain elevated, driven by a narrow group of large corporations. Meanwhile, the broader economy weakens. This divergence cannot persist indefinitely. The bond market has issued warnings for years. The yield curve, the difference between short-term and long-term interest rates, has remained inverted since 2022. Historically, this has preceded every major recession. However, crashes rarely occur when warnings first appear. They occur when policy attempts to silence them. When the yield curve reverses, it often indicates emergency interest rate cuts, not recovery, intervention. If you want YouTube to recommend more work like this, subscribing is the only signal that actually helps. At that point, governments face three options: print money and trigger inflation, maintain high rates and trigger defaults, or choose the third option: financial repression. This involves altering rules to force institutions to hold government debt. Capital becomes trapped. Returns become secondary. Risk continues to grow outside the traditional banking system. Non-bank lenders now originate most U.S. mortgages. They lack access to central bank support. Previously dormant risks are resurfacing. Second lien mortgages, old claims, zombie debt, foreclosures on households that already paid their primary loans. This is systemic fragility. And the pressure is not only internal. In 1956, the United States forced Britain to abandon the Suez Canal by threatening its currency and debt. Britain collapsed financially. Today, the roles are reversed. The United States is the debtor, and the world holds the bonds. Central banks are adjusting. They now hold more physical gold than U.S. Treasury debt, for the first time in decades. Emerging blocs are building alternatives: payment systems, settlement networks, trade frameworks, exit ramps. If energy trade moves away from the dollar, global dollar demand declines rapidly. The petrodollar system ends, not slowly, abruptly. So what happens to personal capital? The model suggests stagflation, high costs, low growth. But the more dangerous signal is capital flight. Watch for an anomaly: stocks rising, the dollar rising, gold rising at the same time. This indicates fear, not confidence. As deficits exceed $2.5 trillion, capital controls become politically viable. Exits close. This outcome does not require coordination, only incentives acting independently. In a private wave, safety does not come from promises. It comes from ownership. Land cannot be printed. Gold cannot be printed. Productive capacity cannot be printed. The system is not failing. It is resolving. The debt will not be repaid. The only uncertainty is distribution. According to the model, resolution occurs in 2026. So consider the question: when every asset is someone else's liability, what do you own that does not require permission?